everybody. It's Mike Preston at New Harbor Financial. It is February 1st, 2024, and we wanted to produce a short video this week that hopefully would give you some insight into the options market. A lot of people ask us about options. That's because here at New Harbor, we use options quite a bit in our portfolio. It's because we use them to hedge risk and reduce risk, and I wouldn't say that we're completely unique in the fact that we use options, because options have been around a long time. But not a lot of money managers or financial advisors use options. We really love to use options. We understand them intimately, and the nice thing about options is they allow us to put boundaries on things. We talked recently about how the market is an infinite environment. That's really a cool thing, and it's also really a scary thing. In an infinite environment with infinite ideas, you can sometimes have infinite risk. In some trades, you can have infinite risk. Normally, when you buy a stock, you only risk the amount you put into it. But there's some trades that you can do, such as shorting a stock, that can theoretically have infinite risk. The nice thing about options is that you can use them to put boundaries. You can use them to create a floor and a ceiling, or to put guardrails in a situation. So this is really kind of how options came about. Economists were talking about, how can you put guardrails on a trade? How can you create a situation so that you can take the worst case scenario off the table? So this is how options came about. They started to be thought about in the 1960s. And I'm going to go through a brief history here today, and just talk about some questions that came about. What we did is we went to Google on January 30th, 2024, and we started typing options into Google, and up popped 30 or 50, 30 or 40 or 50 different top hits. These are top questions that people are asking about options. So we've compiled what we think are the best of them, and I'm going to take some time and go through them here, and hopefully it will be insightful for you and things that you can use potentially in your own portfolio and in your own trading going forward. So I'm going to go ahead and share some of these questions now. So the first one that pops up, the question that people are asking, what does options trading mean? Well, options trading means you're trading a derivative. You're not trading a security directly. A security is a stock or a bond or a mutual fund. It's an ownership right in something that is permanent. An option generally is not permanent. It is time-bound. An option is a contract. It is a derivative on something real. So an option essentially is a derivative that gives you the option to buy or sell a security. Generally, not the obligation to buy or sell a security, but the option or the right to buy or sell a security. Who invented options trading? Well, I talked a little bit before about how the concept began to be talked about in the 1960s. There's been global trade going on for decades, actually hundreds of years. But as we reached modern times, companies were looking for ways to hedge risk or to lock in certain prices for commodities generally. So this is how the concept first came about. And in the 1960s, economists started talking about this and how they can model this and how they could create a concept that would be a derivative that would allow individuals, but it was really companies first that wanted to put guardrails or limits on their risk in global trade with each other. And so two economists, Black and Scholes, came up with this Black-Scholes formula. There's a third gentleman in the mix here, Merton, who wrote a paper on their theory, and he's sometimes credited for inventing this as well. But the Black-Scholes formula takes all of these different variables: stock price, exercise price, the interest rate, time to expiration, etc. Now, thank goodness you don't have to be a mathematician to use options, but essentially almost all options are based on this Black-Scholes formula. This was a breakthrough, and in fact, these gentlemen, Black-Scholes, received the Nobel Prize for Economics in 1997. I do believe that Black passed away in 1995, and received it or posthumously received it after his death, but it was the 1997 Nobel Prize in Economics. Now, all of these equations are built into all of the systems that are used to trade options today. Is options trading profitable? As a big hit in Google. It can be profitable. It can be profitable for you, or it can be profitable for the exchanges and for the big players. And we're interested in helping you figure out how to make it profitable for you. We'll talk a little bit about that later. But like anything else that involves risk, you should not be involved in options if you're not experienced or connected with an advisor that understands options intimately. Just like anything, you need to make sure that you understand what you're doing if you're going to get involved in it. Is it gambling? Some people think it's gambling. Well, options can absolutely be used in a gambling way. In fact, that's probably what gave some options a bad name. Options allow you to create leverage, to buy a lot more stock than you would otherwise be able to with cash. And so therefore, it could be construed or seen as gambling. At New Harbor, we never use options like this. We only use options essentially to hedge. We never introduce leverage with options. And for instance, if we have 100 shares of stock, we will use one contract, which represents 100 shares of stock, to hedge that. It's possible, though, to achieve leverage of 10 to 1 or more with options. And if you used it like that and you didn't know what you were doing, absolutely, you might call it gambling. What I want to portray here is that in our mind, the correct way to use options is by not introducing leverage and using options to simply add guardrails to your position. So in other words, if you use options this way, it's actually safer than buying 100 shares of stock. If you buy 100 shares of stock and then sell a call option that promises to sell it to somebody else higher, that's actually safer than just buying the 100 shares of stock alone. So in our view, no, it's not gambling, particularly if you use them correctly. Is it worth it? Is it worth the effort? Well, that's really only up to you to decide. It's worth it for us. We've spent a lifetime and a career learning how to use them. For the individual, it may or may not be worth it. We're happy to have a conversation with anyone that wants to chat about it. And there are very easy ways. For instance, the covered call example that I just mentioned, I think is absolutely worth it for the average investor. It's not hard to do. It's easy to build, and it actually reduces risk. Is it good for beginners? Well, if you use the safe strategies, I think that yes, it's good for beginners. But you've got to be careful to not do anything that you're not comfortable doing. You can even paper trade options, or which is essentially create a trade, don't actually execute it, but paper trade. There's some accounts that you can do this, and you can use their platform and actually act like you're doing the trade, or you can simply write it down on a piece of paper and say, this is the trade that I'm going to do. I'm not actually going to execute it, but I'm going to write it down, and I'm going to come back later and see how it went. How do you learn about options trading? Well, this is the hard thing. Like most things in life, the reality is not as scary as the anticipation of what it's like to get going. Options are easy to understand if you go slowly and use the simplest, safest strategies. I learned options by reading this book, Larry McMillan on Options. Larry McMillan is a legend in this business. I had the pleasure of seeing him present one time. There's updated or revised and updated versions of this book, but this is the Bible of option trading. It's about 3 inches thick. And there's hundreds and hundreds of different option strategies, but I would focus on the ones that are simplest. There's also various different websites you can go to. Places like Investopedia has basic descriptions of option strategies. You can watch videos, and furthermore, we're happy to chat with folks and describe to them and even show on our screen what a basic option strategy can look like. But there's no substitute of doing a little bit of studying, doing some paper trading, and then eventually doing very small trades in your own account using real strategies. Why is options trading dangerous? Well, I said it before. If you use leverage and you don't understand this thing called time decay, options trading can be very dangerous. Options have this thing called time decay, which means it's like it's often been described as an ice cube in your hand. Put an ice cube in your hand, it's going to start to melt. And an option is like that. Since it's not the real underlying security, only a derivative on that security, the time value can be a dangerous thing because it melts away every day. There's this thing called theta, which is the time decay, and it really works against you if you buy an option. So you can get a lot of leverage with options, but you also expose yourself to a lot of time decay if you're buying options. That's actually a key, because if you're selling options, you're creating or you're receiving the time decay. So one of the biggest, most powerful things from a mathematical point of view is the time decay of options in this field. And so in general, the people that make money in options long term are professionals that sell options. And what we're doing more often than not at New Harbor is selling options. So we might buy a stock at $100 a share and then sell a call option at $110 a share, $10 higher or 10% higher. And what that does is it brings money into the account for that contract that we sold up at 110, and it puts a ceiling on that stock. But the money that we bring in adds income to the account, and it reduces overall risk. So sellers of options, if you do it over and over and over again, have a more consistent pathway to become profitable, stay profitable. And that is a key. Options trading can be dangerous if you go all in on one idea and if you use too much leverage. But it can be a fantastic thing if you've got a long-term view, your position size is smaller, and you can get time decay on your side. That's key. You want to get time decay on your side. Why is it difficult? Well, it's difficult because people make it difficult. There's all kinds of strategies that are advanced. Ratio spreads, ratio back spreads, iron condors, butterflies, etc., straddles, strangles. All of them are pretty cool strategies, but don't make it more difficult than it has to be. Start simple. Do a simple covered call strategy is my advice. It doesn't have to be difficult. You can always get more complicated later. It doesn't have to be difficult. Can options trading make you a millionaire? I suppose. Any type of investing can make you a millionaire. But in general, it doesn't, because folks plunge into the options market. They take too much risk. They're over-concentrated. They go all in on one idea. And invariably, they buy options versus selling options. And when you're buying options, you're exposing yourself to really steep time value decay. And if you don't have the time exactly right, you will lose. The best way to become a millionaire, if that's what you really want to do with options, is take it slowly, little by little. Get time decay on your side. Take it slowly. Be patient. Don't worry about making a lot of money. Just let yourself ease into it, learn how to use options, and build from there. Don't go into it thinking that you're going to become a millionaire. Are options trading losses tax deductible? Absolutely. Trading any security or any derivative is going to have tax consequences. If you make money, there's going to be capital gains taxes. Generally, with options, they're going to be short-term capital gains because they're less than 1 year, most of them, not all. And if they're losses, they're going to be capital losses just the same. There's some options that you get special tax treatment. Options on futures contracts have some special tax treatment. That's a little bit of an advanced topic, but for instance, if you were to buy index options on the S&P 500, they would be treated, gains would be treated as 60% long-term gains and 40% short-term gains, no matter how long you held them. So that's kind of a special thing to understand. Not that relevant right now, but just something to think about, and that's for index options. Can you make this a full-time job? Absolutely. A lot of people make it a full-time job. I don't think that I'd recommend it for most. I suppose we have made it a full-time job, but we've been doing this for a long time and we love doing it. I don't think I'd suggest that most people make it a full-time job. It's just a very difficult thing to do, and it's hard to focus on consistently. But I wouldn't say that you can't make it a full-time job. It's just you're going to have to be really dedicated to it and spend a lot of years learning it. And can you day trade them? You can, but there's this thing called the bid-ask spread in options. So if it costs $1 to buy an option, you might be able to sell it for 80 cents immediately after. And so that bid-ask spread is 80 cents by $1. So if you sell it very quickly round trip, you're going to lose 20% instantly. So I don't think I'd recommend day trading them. I think that you should hold them for a couple days to a couple weeks and maybe even a little longer. But the most common time frame is maybe a few days to 4 or 5 weeks, something like that. Maybe a slightly longer, maybe up to about 8 weeks. But that's the most common. So what option trading is best? And this is the final question. There's no real way to say because it depends upon you, your personality, and what you're looking to do. I personally think, and I think a lot of professionals agree, that the option trading that is best is the one that gives you the highest probability of success. And to do that, I really think that you want to think about getting time value on your side. Because if you think about it, nobody is really ever going to be consistently right about timing. And so you can actually get more leverage if you buy options than if you sell them in some strategies. But the time value of options being on your side, and that is if you're a seller of the options, is going to be a lot more helpful to you and it's going to be a lot more forgiving. So hopefully you found that discussion somewhat helpful. We thought it would be good to just play around in Google and see what people are asking about options. It's a very complicated subject. Tried to make it relatively simple here. I know maybe it didn't come off that way. We tried my best. And, as always, we're very, very willing to talk to people. There's a link in the bio. Take a look at the link in the bio if you'd like to contact us. We're like I said, we're willing to chat. We're willing to offer free portfolio reviews. Happy to talk about options with anybody at any time. So take a look at that link in the bio, click the link, and shoot us an email. We'd be happy to chat with you. And also remember to subscribe to our channel. Our channel is slowly growing. We appreciate our viewers, and we're happy to produce content every week. Please go ahead and like the video and consider subscribing to our channel. And thanks again for watching. This is Mike Preston at New Harbor Financial. Till next time, thank you very much.